Hey guys, welcome back to the Edge Dive. Today we're going to be diving into some of the trickiest and most tested debt securities you're going to face on your Series 7 exam. So T-bills, CMOs, ETNs, what do they all have in common? Well, they each have very specific risks you absolutely have to be able to name for the test. So let's break them down piece by piece, starting from the ground up. So here's the plan for today. We're going to start with the safest government debts you can find, and then layer by layer we'll build up to more complex stuff. It'll all make sense this way. And let's just jump right into it. We're starting off with the US Treasury securities. And really, you can think of these as the bedrock of the entire global financial system. I mean, this is pretty much the safest debt you can own, period. All right, take a look at this table here. It's going to be your cheat sheet for the road. You've got to know these differences. And let's zoom in on what really matters. So T-bills are the odd one out. They're sold at a discount to their face value and don't pay any interest along the way. Notes and bonds, on the other hand, they're more traditional. They pay you interest every 6 months and are quoted as a percentage of their par value. Nailing these little details is absolutely crucial. Here are tips. These are really interesting now, so pay attention. And the exam loves to ask about them because they're all about fighting inflation. Here's the magic trick. When the consumer price index or CPI goes up, the actual principal value of your tips goes up with it. And get this, your fixed interest payment is then calculated on that new higher principal, so you get a bigger check. It's a fantastic way to make sure your investment keeps up with rising prices. All right, let's talk about strips. This is super important. What's the number one risk? Well, since there are no coupons, you have literally zero reinvestment risk. There's absolutely nothing to reinvest. And this is a big but, their price is incredibly sensitive to changes in interest rates. Think about it. If rates go up, that single lump sum payment you're waiting for way down the road is suddenly worth less today. That, my friends, is interest rate risk. And for strips, it is absolutely the whole story for them. Okay, moving up the ladder, now we're going to look at government agency securities. So we're taking one small step away from the pure, unadulterated safety of treasuries. Don't get me wrong, these are still considered very safe, but this is a new layer of risk and reward that you've got to wrap your head around. Okay, exam alert time, guys. You absolutely must know which agency is backed by the full faith and credit of the US government. The answer here is Ginnie Mae. Only Ginnie Mae. That's an explicit guarantee, meaning if Ginnie cannot pay, then Uncle Sam steps in a big way. Now, what about Fannie Mae and Freddie Mac? Well, they're a different story. They're government sponsored, but their debt only has an implicit guarantee. It's a subtle but hugely important distinction you have to know. All right, take a deep breath, guys. We're not getting into the really complex stuff, collateralized mortgage obligations or CMOs. So what's really going on here? We're taking these giant pools of mortgages, thousands of them, and then slicing and dicing them into different pieces called tranches. Each tranche has its own unique risk profile and its own timeline. This is the famous CMO waterfall, and the analogy is perfect. I want you to picture a series of buckets stacked one on top of the other. Now the interest payments, that's like a light rain that sprinkles into all the buckets at the same time. But the principal payments, that's a fire hose, and it's only aimed at the top bucket, tranche A. That bucket has to be completely full before a single drop spills over into the next one, tranche B. That's the whole game right there. That sequential payout structure. So with CMOs, you have these two giant risks, and they're basically two sides of the same coin. It all comes down to what homeowners do when interest rates change. So when rates fall down, what happens? Everyone rushes to refinance their mortgage. For you, the investor, that means you get your principal back way sooner than you expected. That's prepayment risk. Now flip it. When rates rise, nobody wants to move or refinance. They hang on to their low rate mortgage for dear life. And for you, that means your principal is coming back way down. It's coming back way, way slower than you planned. And that's extension risk. So get this, the designers of these things got clever. They realized not all investors want the same kind of risk, so they created something called special tranches to manage it. The big one to know is the PAC tranche. Think of it as the most stable and predictable of the bunch. it has this protective band that shields it from both prepayment and extension risk. Now a TAC tranche, on the other hand, is more of a one-trick pony. It only protects you from prepayment risk, getting your money back too fast, not from extension risk. Okay, well, we've built our way from the foundation all the way to the rooftop, and up here we have structured products like exchange traded notes or ETNs. Now, these are custom designed investments, usually linked to some kind of a market index, but they come with a very different and very critical type of risk you need to know about. And this right here is the whole ball game. An ETN, it sounds like an ETF. It even trades on an exchange like an ETF, but it is not an ETF. Structurally, it's completely different. You're not buying a share in a fund that holds a bunch of stocks. No, you're buying an unsecured debt note. It's basically an IOU from a big financial institution. And that brings us to the number one most important got-to-know risk for ETNs is your credit risk, because it's just an IOU. If the bank that issued it goes belly up, your investment could go to zero. Poof, gone in a matter of seconds. It doesn't matter if the index it was tracking went to the moon. You're making two bets, one on the index and one on the solvency of the bank. All right, guys, let's wrap this up and put a bow on top. We're going to distill everything down to the absolute must-know flashbacks for your test, and we'll see why this stuff is more relevant than ever in today's regulatory world. Seriously, take a screenshot of this slide, memorize it. You're going to have to burn these connections into your brain so that on an exam day, it's automatic. T-bill, discount strips, interest rate risk, Ginnie Mae, explicit government guarantee, CMO prepayment, rates fall, ETN, issuer credit rate risk. You have to know these cold and with no hesitation on the test date. And look, this isn't just about passing a test. This stuff matters in the real world too, depending on your job especially. Just look at this quote from FINRA's 2025 regulatory focus. They are really cracking down on how firms talk about these complex products, especially CMOs. Regulators want to make sure investors actually understand these risks, guys. So being able to name the risk, that's just the beginning of this. Alrighty, pop quiz. Let's get it. What Treasury risk is sold at a discount and matures in a year or less? Think about that. First chart we went over, and I'll give you guys a second. Okay, well, the answer is T-bill. Moving on to the next question. PAC versus TAC. Which tranche has more predictable cash flows? I'll give you guys a second here. Remember, the one with two-way protection? Well, that's right. It's going to be PAC tranche. Okay. What about strips? Well, the question is, what's their primary risk? Remember, no coupons means no reinvestment risk. So what's left? It's going to be interest rate price volatility. Their value swings big time when interest rates move. And the last question I have here for you guys, an ETN investor is most exposed to which type of risk? What's that big scary risk we talked about? Because it's an IOU from a bank, the answer has to be issuer credit risk. So look, you can now name all these risks, and that's fantastic for the exam. But the real next step is, can you explain them to a client? Because mastering this stuff isn't just about passing and getting a passing score. It's about building foundation you need to communicate clearly and responsibly throughout your career. That's the real test. Good luck, guys, and come back for the next.